Hello, welcome to day 3. Today is all going to be about technical analysis. This is what gives you the roadmap to how you're going to actually implement trades, where you're going to put the trades on, where the market is willing to go beyond to the upside, where it wants to hold to the downside. It's going to give you all of those clues, and that's what you really need. You need that map of how you're going to implement your trades, not just a good idea. So speaking of a roadmap, let's crack on and have a look at what we're going to be going through in the next couple of days. Today is going to be focused on candlesticks, and then we'll move on to market profile tomorrow. With regard to candlesticks, what we're going to be looking at is candlesticks to start with. These are the most commonly used variant of technical analysis. Very well watched, and the importance with all technical analysis is if you know that other people are watching it, then what you see within it becomes a little bit more important, because other people are also following those ideas, also looking at the same areas as you are. Yeah, if you find something completely obscure way of looking at a market but no one else looks at that, then it doesn't really help in any way. So we're going to have a look at candlesticks. This is the most common way of looking at markets and what we all use here. We're going to be looking at patterns that get progressively more complex, and we're also going to be looking at your entries and exits. It's fine, all well and good, being able to spot a pattern, recognize certain layout of candles, but if you don't know where to enter the trade or where to give up on the trade if you're wrong, then it doesn't actually help you in any way. So it's all about pattern recognition. That's what trading's more about. It's not about being able to look back at a chart in a few weeks' time and say, oh yeah, that was a fantastic pattern. So that's what we're going to be going through. Beyond that, I'm then going to take you through indicators. Some of the indicators that I use, these add an extra layer to the picture that you've built up from the candlestick patterns. They give you a little bit more information, confirm an idea that you may have, give you a clue as to whether a level is strong or weak, whether it is likely to hold or not. So we're going to have a look through volatility indicators, predominantly Bollinger Bands. Then going to look at a couple of other areas, really revolving around movement and volume. So I'm going to look at VWAP, the volume weighted average price, as well as the ATR, which is your average true range. And we're also going to have a little look at volume, why that's so important, and where it actually helps you with a trade. It confirms a trade, or perhaps takes away the desire to stay in a trade. If you're not seeing volume, confirm something for you. Tomorrow, we're then going to go through market profile and have a look at some price ladder examples. So I'll speak more about that tomorrow. And of course, at the end, joy for you. You can have a little quiz. It will be a chance for you to sort of branch out, learn about a few other things, do a little bit of your own research as well. It's not going to be a case of remember what I've said and stick the answer in, or re-watch a video and stick the answers in the boxes. So that's what we're going to be looking at, and that is how we're going to be moving forward. So let's continue. Okay, so I've said that technical analysis gives you a roadmap. The difficulty is, unlike an actual roadmap, is it doesn't actually tell you where the market is going to go in the future. It only gives you a reference to what's happened in the past. So that's where your difficulty lies. What you've got to establish is, where is the market going? You can do this based on what's already happened. The next question you've got to ask yourself, and this is very important in where it's going, is how good a job it is actually doing of it. The market is really struggling to do what it looks like it's doing, so perhaps it's moving higher. If it's beginning to struggle, then you can start questioning how much more is in that move. And again, that is then going to bring you to the next area. Is this about to change? Are we going to see the end to a move? Are we going to see perhaps just a pullback and continuation? Yeah, it is something changing. And also, you've got to ask yourself, is the market balanced or imbalanced? The market usually switches from one to the other. So an imbalanced market is generally a trending market, and then you'll get a more balanced market where it ranges and consolidates after the trend. You don't often see a market just imbalance continually. You'll see this fluctuation between the two, and you will see this intraday as well on shorter time frames. Anything that can apply to a daily time frame can also apply to a shorter term. Now, what you're really looking at, and what tells you all you need to know is support and resistance. That's going to tell you whether you're in a trending or a ranging market. If you're in a trending market, then the support and resistance will change. So an area that is resistance will eventually become support. So as the market moves through the resistance, as you can see on the smaller chart on the left, that resistance then becomes support. So as the market comes back to it, that gives you a clue as to where you have an opportunity to buy. Likewise, on the downside, you see this continual shift of resistance as the market drops. In a ranging market, you have a situation where it just fluctuates either side, and you won't get any real break of the range. And this is indicative of a balanced market. The longer you sit in a range, however, the more likely the market is then to become imbalanced as people positioned one way or the other within the range begin to get out one way or another. So let's go into support and resistance a little bit more. Key areas that they come from are previous areas that the market has traded in. So these are going to be previous daily highs, daily lows, areas that the market has perhaps moved up to and come back off. Once you get back up to them, that is going to act as a resistance. It's very clear, people can see it. And again, this is to my point that if more people are watching candlesticks, watching certain patterns, then more people will notice those levels and react to them. So that's your first strong indication of where you're going to get a support and resistance area. Now, key thing to remember, and I have already suggested this, is that once they are broken, they will then switch. So a support will become a resistance once broken. I'll show you a very good example of this in a moment. And likewise the other way, resistance will become a support. So you get a very clear clue again. If you do see a resistance break and it doesn't become support, then clearly that break has not been so strong. And what, again, coming back to that question of how good a job is the market doing, clearly it is not doing such a good job because it has not turned that previous resistance into support. Now, key thing to remember with any support and resistance area is the more times it's tested, the weaker the area becomes. It doesn't, slightly counterintuitively, become stronger, it becomes weaker. The reason for this is, if, say, for example, you went back to look at that ranging market, every time we rise up to resistance, you get some sellers coming into the market. The sellers will then hold on to that position, looking for a move through that lower support. And likewise, you will get buyers at the support looking for a move out of the range. So the more times it tests an area, the more accumulation of positions on that level or around about that level. When it breaks, or it becomes more and more likely to break, and as it does break, then you've got all of those positions that need to get out, and that's what creates the break. As those positions start to go offside, they then turn around and push the market away from the level. Now, bigger time frames are more significant. You can bring it right the way down to sort of a 5 minute, 1 minute time frame, and you do get smaller moves. But remember, if you're using a smaller time frame chart, consider the move on that smaller chart. Don't sort of look at a very small level on a 5 minute chart and then expect it to play out into a larger move on a daily time frame. So keep your time frames in mind, they're very key. Bigger time frame levels are more important. Pretty obvious reason for this. Larger participants are not concerned about what's happened in the last 5 minutes. They're not looking for the next 0.1% move. They're looking for the next 10, 20% moves. So it's larger areas, larger swing highs, swing lows that will actually create the bigger levels, bigger support and resistance. And this is purely down to the type of participant at those levels. Now, a level is very rarely strictly just a price. It would be very naive to say, right, if it ticks through a certain area or goes just beyond a certain area, that level is broken. It's not. It's very often a smaller range. Now, depending upon what market you're in, those ranges vary. If you're trading something like the Schatz, a level could break with really a 1-2 ticks through it. Whereas if you're looking at something like the DAX, a much more volatile market, then you could be looking 10 ticks through an area before you've actually broken it at all. You know, that just becomes a smaller area. So be aware of that, and you will learn this when it comes down to what market you're looking at. You'll become used to certain markets, and that will appeal to some people, it will not appeal to others. Some like the definitiveness of a more rigid market. Some can accept that little bit of play in every level. It gives you a chance to sort of finesse an entry. You don't have to enter bang on the level. So they are very rarely a single price. And the key thing, and this is very key with even a range area of a level, it is not broken until you see a close beyond it. The close relates to the time frame that you're trading. So if you're looking at 15-minute chart, you want a 15-minute close through the level. That then tells you it's broken. Until then, yes, it can swing all the way through, and I'll go into this with entries and stops a little bit later on. But yeah, you may get stopped out on a push through a level, but it then closes back below it, say, if it's a resistance level. The level isn't actually broken despite the fact you have been stopped out, and perhaps that's because of your stop is based on a distance, which is understandable. You know, you could see a huge move through your level that eventually comes back. You can't just sit there and just take all of that heat. So be aware, the closes are exceptionally important with levels. Okay guys, so we've got a fantastic example here in the DAX of range bound trade, levels working, but also levels with a little bit of leeway in them. So what you can see on the left hand side of the chart is very range bound trade. This lasted for about 2 weeks, with the DAX trading between 11,412 to 03, right the way up to 11,482 to 87. Now note, each time you get into that area, you generally see a wick on the candle, and also you never see the body of any candle close outside of either 11,412 to 03 or 482 to 87. That is a very clear example of how, one, the importance of a candle close is very key, and also that a level is not, you can't draw one line that says that is the level. A couple of times you get a little bit of a spike just beyond those little ranges. That's down to you then personally on how tight you have your stop as to whether that will get you out or not. Being as it's the DAX, I would think at least 10 ticks beyond the range, and that is unlikely to get you out. We then got the resistance to the upside turned into support very nicely. So we had one breakout day where the market tested the low of the range, aggressively moved back higher, and that's where you see that large couple of green candles that moves the range, or moves the market out of range to the upside, get an explosive move up, and then another slightly range bound market, but not range bound in quite the same way. This definitely has a bit more spikes to it, not the clearest of ranges, but that old resistance at 11,482 to 87, we have a test down. It provides a fantastic area to get into a trade, gives you a very quick entry, and you get almost an immediate bounce. The market rushes back higher and you have a very nice trade on that. So you would be looking really back into the range, back towards that high volume area that you can see on the right hand side of the chart. That little histogram shows volume, so that's the highest volume traded prices where the histogram sticks out the most. That would be your target. If you are buying that support that was old resistance, run it back to that high volume area, as that will attract prices back towards it. So that's what we got in the DAX. Very, very good example of support and resistance, levels being a band rather than just a single area or a single line, and how resistance then becomes support once broken. Here we've got two basic candlesticks. These are the key things you need to know about a candlestick. The color is important. The color tells you whether the candle has moved up or down. So if you have a green candle, that means that the open of the body, the thicker part of the candle, is at the lower end, and the close is at the top of the body. Outside of that, you have a wick. The wicks symbolize the distance that the market has moved within that candle. Now, how it has done that, you don't know. So the candle on the left, we saw an open lower down. It could have tested lower and then moved higher and then pulled back to the close. However, it could have opened lower down, tested all the way up to the top, the high of the range, all the way back down to the low, and then still closed higher. So what the candles don't tell you necessarily is how the market has moved within that time frame. It tells you how well the market is doing at actually getting to where it wants to get to. So the bigger the body, the more conviction of the candle. Likewise, on the other side, you have a red candle indicating that the market has moved down. The wicks are also called tails, or buying tails and selling tails. So a tail at the lower end is called a buying tail because that tail has been created by buyers. A tail at the top end is a selling tail that's been created by sellers entering the market and pushing the market down. So if we go and move on to see how candles develop, I've just sort of referenced this anyway, but what you've got here on the left, you've got a candle that has moved down with open, no wick to the upside, so there's been no actual attempt to buy and sellers come in, so the market has just moved straight down, and then you've got a small buying tail. But within this candle, you would have seen likely a shorter time frame candle that looked particularly strong to the downside. No wick, no buying tail, so that is showing a lot of conviction. However, we did see a bounce, and this is why that close is so important. Until it's closed, you have not got that fully high conviction solid candle to the downside. So that's what you've got to be watching out for. And there you can see it, that little bounce creates that close at the low. Now that still looks a reasonably bearish candle to me. The market has come off and it has definitely closed at least below halfway of the candle. You've got a reasonably small wick. However, if we go on to the next slide, you'll see that what could happen is you see this reasonably strong looking conviction candle down that is then turned completely around, and what you're left with is a very, very large buying tail and actually a green candle where the market has shifted lower and then closed higher. So be very aware of those closes, and that just gives you a little indication of how the candles can actually develop over a little bit of time. There are essentially three different types of candle. You either have a solid candle, which shows a lot of conviction, a doji, which shows indecision, and a rejection candle. So let's have a look first at a solid candle. What this is showing is that from the beginning of the candle, the buyers or the sellers have taken control, driven the market one way, and held it there as well. So no one has been able to change the conviction. The market is very clearly one directional, and that is showing a lot of strength. The size of the candle again is very important. You know, if this is a very small candle compared to what an average candle is, then it's less important. Again, volume adds to that as well, and we'll see this in the indicators a little bit later. But in general, a solid candle does show conviction. If you get a particularly outsized candle, this is called a Marubozu. Key thing with a Marubozu, and something to remember and look out for, is the difference between, or the distance between, the open and the close. So if you have got a very, very small wick at either end, it can still count as a Marubozu. That area, the halfway between the open and the close, not the high and the low, the open and the close, is known as the Marubozu line. This can often provide a decent support or resistance the next day if you're looking at it from a daily candle. I do prefer to look at a Marubozu only on a daily if you are looking at that level. Now, a doji does show complete indecision. The market has tested one way, tested the other, and ultimately closed nowhere different to where it opened. This is showing very little decision from the market. The key thing with a doji candle is where it's positioned in a sequence. If it's in the middle of a range, it has very little bearing on what is going to happen next. However, if you start seeing a doji candle at the very top of a range, showing the market is very indecisive and generally is an indication of weakness, because if you've seen a strong move in one direction and the market suddenly just has no decision about what it wants to do next, now even if you see a pullback, that's often a better sign because it's showing that people are taking a bit of profit. You just see a complete doji, then that is showing a great deal of indecision and generally an indication of a reversal. But as always, the position in the sequence is very key with a doji. Next up is a rejection candle. These are generally known as a hammer or a shooting star, whereby you get, well, a hammer or a shooting star if they happen at the high or low of a range, and that again is where they're very important. If they break the high or the low of a range, or create the high or low of a range, and then you see it's very quick rejection, very small body after the market has moved in one direction, then it's showing that the buyers, in the case of a red candle or one with a very large selling tail, have run out of energy, and all of those people who have been buying it into that move up have then been rejected, may still be in position. If we then start to continue a move lower, so a rejection of the current move, then they start to get out, and this adds to the selling pressure. So that's what you need to remain very aware of with these types of rejection candles. More important, again, in sequence, like a doji, at the high or low, that's where they become most important and do signal often a turn. Okay, here's a few examples of those candles that we just talked about. First up, we've got an inside day. Now, these often occur where you get a strong conviction candle, so a solid type candle. You then get a consolidation the next day. This is where the market pulls back, takes a little bit of a break, and this again is moving from that imbalanced move to a balanced move. Market then consolidates. This way you get a little bit of selling, bit of profit take, and also a chance to accumulate a few more longs if the expectation is for this move to continue. Once you get the break of the inside day, so the following day, as the market breaks that candle, you're then looking for that continuation and potentially another imbalanced day, trend type day, that creates another conviction candle higher. In the case of the doji, doji is at an extreme. As I said, they're very important, and what you're likely to see is a move higher. Doji, which shows that complete indecision, and then once the market starts to move lower, particularly once it starts moving into that lower part of the doji, then you're then expecting a move further down. On the candlestick on the left, again, that would be a Marubozu, so the midpoint of that high and low, of that open and close, would be a very well watched area and likely to give you at least a small bounce. Now finally, you've got the rejection candle, and this, in this example, is a pretty much perfect hammer. So what you have is you have a move lower, again conviction lower, another push lower that is completely rejected. You get a close with very, very small body candle. So everyone selling that second day, looking for that continuation of the move, is now caught short. As they get out, they have to buy back their shorts, and that's what creates the move higher. Now, a combination of candlesticks is often more important, so it's the pattern that's developing rather than just the actual candle itself. Now in this example, first up we'll look at rejection patterns. What we've got here is a market that has moved higher and is then building higher, but a little bit more slowly. You're seeing that the candles are not really gaining much. You're getting more and more wicks on the candles as the market moves higher in the example on the left. You then get a bit of consolidation with a large wick. This is a complete rejection candle. A shooting star is also a swing rebound. A swing rebound occurs where a market opens, moves higher to break a previous high, if you're looking at a swing rebound to the upside, breaks the previous high and then closes back within the previous day's range and below the previous day's close. So in this example, we have got a swing rebound as well, because we closed below the previous day's close after breaking the high. And then your next expectation is that as the buyers have failed, they get out, you get that selling, as we've already mentioned. Next example is you get a double top. This is where the market tops out at the same price, so previous resistance maintains the resistance and the market starts to come off. Two ways of playing this trade. You can go for the aggressive entry, and that would be to enter at the previous high. You can have a reasonably tight stop on this trade, but there is no guarantee that the trade's going to work out. There's nothing confirming your trade. You are just essentially guessing that the previous high will maintain resistance. The other entry is as you break the previous day's low, or if you have had a sequence of a move higher, a pullback, a move higher to double top, and then you break that lower low. That again is your confirmation of the double top. That gives you the entry, and again you are looking for a move back towards where the initial move began from. So again, you're looking for that conviction candle down as those longs realize that they are no longer valid and get out of the trade, initiating more sales. Again, like I say, once you get that confirmation break, new sellers are going to come in as well as the longs that are getting out. Okay, so you've seen a rejection. What have you got for a continuation pattern? How do you play this? Now, what we've got on the left is the setting up of a flag. So you've had a move higher, followed by a couple of consolidation days. The number of days is not that important. What's important is that you have this downtrend. So you've got a very clear trend down as the market is drifting a little bit lower. So people are taking a little bit of profit. What you then need to see if you are to get on this trade is a break of that trend and a close above it. The close is very, very important. Now your entry is on the break of the trend line. Your stop is going to be below the low of that previous lowest candle, so that final red candle. That's where your stop is going to be, or your stop is going to be any close back below that trend line. To see the continuation, what you really want is a close higher, and you then want a break of that previous high as well. That's going to really confirm the trade if you get the break of the previous high, because that is showing that you've got a new higher high. Higher highs in sequence creates a trend. So that's what you're looking to see on a flag. Target on your flag is the height of the pole, so the distance of that whole previous move up before you began to flag to the downside. And that's what we see there, that continuation higher. Next up, you've got a double inside day. So a double inside day is whereby you have a move higher and then 2 days, one within the other. The break of the smallest, most recent day gives you your entry, so you're looking to buy on a break of the high or low of that candle. Double inside days are less of a definitive continuation pattern, and you could see it break to the downside and that will see a move lower, but generally you are looking for a move in the direction of the mother candle, that larger first move candle. So as you get the break of the first day, you are looking to get an entry. You are then looking, perhaps on a shorter time frame, to have an entry on the break of the next day as well. So it gives you a chance to pyramid. Your target is a minimum of the top of the mother candle. You're then looking for any continuation pattern, so perhaps a shorter term flag to keep you in the trade and look for a move higher and higher. And that is what you get. You see that continuation and move on up. Okay, now this is quite a tricky trade, and these are some of the failure type trades that are quite tough to execute, because you've not seen any break of the flag in this example. So no one's got long to necessarily tell you that they're stuck in a position and are likely to get out. What happens is over time the flag drifts lower, so more people do buy in the flag preemptively looking for that break. But when it doesn't come, you start to break down, and you want to see a little bit of volume come as the breakdown continues. Once you start seeing that, then the market generally rolls over and you get this momentum flush as all the longs, the preemptive longs that were trying to get in for the break or hold on to their longs that they'd had from that move higher, get out. Often this happens below 50% of the flag pole. So any flag that gets below 50%, you're generally thinking it is not or no longer a flag, and therefore any longs that are still in that trade are likely to start getting out. So watch out for the halfway back down the flagpole, quite a key area, and can be indicative of this type of rollover and the longs just getting out because they've had too long basically where they're not getting paid for holding their risk. And finally, a slightly better failure, if you will, because what it does give you the opportunity to go the other way, catch the move, and at least make the money back that you're likely to have lost on that initial move of the break of the flag. So you would play this like any flag. Ultimately, you don't know that the flag is not going to work until it doesn't. So your entry is on the break of the trend line. Your stop, as I've said before, is a close below the trend or below that most recent low candle. So it's actually the last green candle before the break of the flag. Now you got a little bit of clue because the flag broke and then couldn't take out the previous high. That immediately starts giving you a little bit of doubt in the trade, and so once it starts reversing back through that trend line, you've then got a possible short and you're looking for the reversal. The good thing with this trade in a way is because the flag has broken, you have definitely got longs entering the market, and those longs are generally weaker. Reason being, they're momentum longs. They are the shorter term traders who are getting in on the flag for that second wave higher, that continuation move. Those are the people who are going to get out as it starts to break back lower, including ourselves who, have seen the trade not work out. It has proved us wrong. But knowing that there's other people in that situation, this is very, very key to remember what other participants are likely to have been doing, what positions they're likely to be in. You know that they're long, they're then therefore going to be getting out, so you've got a potential short. This at least can get you your money back, if not actually produce a trade for a move much lower, and that's what you start to see, this flush out of those weaker longs initially, and then again the stopping out of the other longs and initiation of shorts as you are not seeing a continuation of the trend, no new higher high, and you're actually getting a lower high, or sorry, a lower low as opposed to a lower high. You've seen a lower high and a lower low. So that's what we've got there. That is a perhaps more tradable failed break of a flag. Okay, let's look at some price patterns. Now, when you actually see these on charts, they're not going to be quite as exact as I'm going to draw. I'm going to draw the basic pattern of it as opposed to the candlesticks. So it's an indication of what you're trying to look for, but these, as we'll see in a moment, can become a lot more complex than just simply a head and shoulders, a double top, etc. So we'll go on to that in a moment, but for the time being, we'll actually look at the pattern that you're looking for. So starting off with a head and shoulders, what we're looking for is a move higher. You then get a pullback in this move. That's where people are taking profit from this move up. Perhaps it's come from a level, but you're seeing a little bit of a pullback, and then the trend resuming higher again. You get a new high, and often a new higher low. The height of the next low is not entirely significant to the head and shoulders. It doesn't have to be a higher low. It can be a lower low as well, and you still get the head and shoulders pattern. Now this is where the head and shoulders actually comes in. You then get another move up, which fails. What I mean by fail, for this to be a trend to continue, you would want higher highs and higher lows. You're not getting the next higher high, and you then start seeing the market come back off. You're now thinking in terms of, you've got a head and shoulders here. What you've got, shoulder number one, head, shoulder number two. So let's have a little bit of a think about what people are thinking in this situation. You've got people long over here who got on the first move. You've then got people long on move two who perhaps are staying in, trying to hold on as well for a continuation of trend. You've got to accept that trends are not just going to continue indefinitely higher. And then you've got more people buying move three, looking for the continuation of the trend, looking for this high to get broken. So what are these people now thinking? Where am I going to get out if we start coming off further? So your initial thoughts, we're going to be looking through this low, perhaps through this low, but also in terms of the head and shoulders and how you're going to trade it, you're looking at the neckline. Neckline being the joint of the two most recent lows. And the idea of the trade is, as the market comes off, as you get through the neckline, that's where you've got your sell on the break. And then you're looking for a continuation lower. Where are you looking for it to go to? Well, your target on your head and shoulders is the height from the head down to the neckline added to the break. So that gives you your approximate target. With all targets, I don't actually take it to mean that the market has to go the exact number of ticks that the target is. I prefer to look at it more as an area to be considering in terms of, if you've got a level, say here, just above where the target of your head and shoulders is, that's where I'd be looking to get out. I wouldn't be looking for it to go all the way to the head and shoulders target. You're thinking in terms of down here, people may be coming in to buy for a little bit of a bounce there. So that's going to be my target on a move like this, rather than the absolute precise target. Another way of looking at head and shoulders as well, if you do miss this entry here on the arrow, then what you're looking for is a potential move back up. Hits the neckline once again. This does often then become resistance. So this is where a trend line becomes a resistance as opposed to just a level. You hit the neckline and you've got another entry here and a continuation lower. Now, where's your stop on this trade? You've got two ways of doing it. You can either have a stop on a candle close above the neckline. So, you know, we start seeing this move back higher, and you then get, let's erase a couple of these arrows. So as you get this move higher, rather than it bounce from the neckline, you get a candle that moves higher. And you get the close up here. That's going to be your signal to exit. Alternatively, you keep your stop above the right shoulder. Now, obviously, this could be quite a big stop depending upon the time frame you're looking at, but if the head and shoulders pattern is to work, then you shouldn't be seeing a move back above the right shoulder. So that's how you play a head and shoulders. These two patterns both are reversal patterns. So again, double top. We showed you a double top a little while ago in terms of how the candles look, but essentially what you're looking for is a move up, hits a high, comes back, we may see a bit of consolidation here, up again, you hit the same high, and then come off. Now, there's two ways to trade this as well. What you've got is you can take a trade with a tight stop up here and preempt it, but ultimately, this isn't trading a double top. This is trading a level and then hoping it becomes a double top. So, yeah, there is a valid trade here. Take the level as you come back to it. Of course, it all depends on how we approach the level, and this will become clearer in the next few slides as well. But you come back to the level, you can get in on the level, you can have a tight stop, say there, for example, a few ticks, depending upon your market, you will know what an appropriate stop is, and then look for the market to come off. The proper, if you will, entry on a double top is a move back below this most recent low here. Once you get a close of a candle below this low, then you're looking for the continuation down, and your target on the double top is the most recent swing low. So if we had seen a move like this before you saw the move higher, this would be your target right the way down here. So it doesn't necessarily have a sort of price-based target as in the head and shoulders. It more is looking for a move back to the most recent swing low. However, you could, like a head and shoulders, also consider that distance there as well and add that to the break. So maybe a little bit less. So that's how I'd look at a double top and a head and shoulders. Your stop on the double top, again, you've either got your stop on a close back above this line here, or you can have the stop right above the top. Obviously, the larger the stop, the less chance of it being hit, but of course, if you do get it hit, then it's going to be a bigger loss. That's why there is some decent risk reward in taking this as a double top, particularly if it's a strong level, particularly based on the way that you get there as well. So do watch out for that on the double tops and head and shoulders. So that's your reversal patterns. Let's have a little move on and have a look at some continuation patterns. Does all depend on the type of trader that you're going to be as to what works best for you. Now, flags, triangles, pennants all have very similar characteristics. It's ultimately just a case of how they're drawn. But a flag consists of a flagpole, so that's your impulsive move higher. You then get the market coming off in a range downwards. Now, what's happening here is you're seeing people take profit, the market is consolidating, and we're seeing now if we can get any more buying. You need a new impetus to get more buyers up here. Remember, if you've been buying down here, are you really going to be wanting to buy in this area up here? Possibly not. So where's the next buying going to come in? Perhaps it's new impetus, perhaps it's new news, whatever it is, you're looking for a continuation. If you break this line, the slope of the flag, you're then looking for a continuation higher. That's where your entry is on the break. To help it out as well, you want to see volume increasing on the break as well. And your stop is going to be a move back below the flag line, the sort of downward sloping trend, or alternatively below the most recent low. There are your two stops. In terms of target, your target is the height of the flagpole added on to the break. So you can add that on over the break, gives you a target. As I said before, obviously if you've got a level here, that's what you're going to be looking for, as opposed to the exact precise target. I always feel that that is the case. Triangles, very much the same kind of thing. At the top of a flagpole, and you then see this type of action. That's not a particularly good triangle. Let's have another go at drawing that. So you see it as a continuation. Much better. There we go. So what you have then is this type of flag. Could be called a triangle, a pennant. Again, you're looking for the break upwards for the continuation. However, this is then giving you an indication that if we do start breaking down, then we have got another secondary move down. So do keep your eyes open for that. You've got the move both ways with triangles. Again, you have with a flag, but it's a slightly trickier trade to actually establish. You know, if you sell this low, ultimately you're not going to get on side enough and it's going to come back up. You sell this low, the same, and you sell this low, the same. It's a trickier trade to see, whereas with a triangle, you've got the trend lines in both directions, and so that gives you a trade in both ways. If it is to be a continuation trade, something that I didn't point out with the flag, but this is pertinent to both, if these pullbacks get more than 50% of the way back, it is generally considered that it will not turn into a continuation trade, and effectively the flag is over and done with, so you won't necessarily be looking into it. Whether this is entirely true, this is a little bit arbitrary. I do know I trade the DAX quite a lot, and I'm quite a big fan of seeing a market pull back to the 618 retracement, looking at Fibonacci's that is, pull back to the 618, and you then see a continuation on from there. So gauge it by your market, but the general consensus is if it comes back 50%, then it is no longer trade. Also, if I draw this triangle a little bit bigger for you, if the market gets more than 2/3 of the way down the triangle, again, it is then deemed that the trade is not really on for a continuation. So once we get past this point, you're not actually looking for a break either way. And potentially you are then looking for the market to just continue moving sideways into a larger consolidation phase. Right, here's some examples and how you'd actually look at trading them. So first up, we have got over here, we have got a flag. This is an example of a flag to the downside in the DAX. What we've seen is we've had a move down from 115.83 to 22, so you've got around about a 60 tick move. You're then looking for a further break on that. What we've actually got on this flag is a fail to reach the target, and that is perhaps why you see this very quick move up. Once it's rejected down at these lows down here, you get a very quick move back up. Like I say, 60 tick target. We break the flag at around about 30s. We do see the increased volume. Look at this volume building up down here, and you get the break. Now, this could be quite a tricky one in terms of getting a trade on. If you weren't in on this candle straight away, very quick, you've then got quite a tough trade on. What you have got as a secondary thought is on the break of this low here and a close below it, you've then got the opportunity to have a sell. Yes, you have got a bigger risk on it that you are ultimately going to be selling down here, but you can have your stop just above the 115.22 area and look for a continuation a little bit lower. So as I say, it didn't quite make the target. We did about 40 ticks on that, so always be aware of that as well. You know, consider scaling. This could well, these 114.88s are actually quite a good level. I've got an example. We used that example earlier on in the presentation. So there's 114.88, very good level, and that's why it held there. What you've got, again, as I pointed out with the head and shoulders, is you've got a retest. Retests, I often think, are in a way the better trades. You're not looking necessarily for it to continue and go all the way to the target. You're looking for a bit of profit to be taken, a little bit of extra selling to come in. So on the retests, I would just be looking for the next logical level. So you're going to be looking back down towards this low. So they're not going to be huge trades, but you know, you're looking 10, 15 ticks taken off that retest, and you get 2 shots at it as well. So that's where I'd be looking for trades. As I say, in terms of stops, entries, there's your intended entry. Your stop is going to have to be up above here, which puts you up towards around 115.50. So you're taking about a 20 tick stop on the trade, but you have got a 3-to-1 risk reward. Your target is 60. As I say, it's a very clear level there, so your target is more likely to be 40. Still, 2-to-1 risk reward on the trade, and you've been backed up by the volume continuing with you. So that's your basic flag in practice. As I say, doesn't necessarily always go to target. So moving on, we have got here a double bottom in the Bund. And as you can see, very much like the picture, we've got a low down here, followed by another low. Notice both candles have got big wicks on them, clearly rejecting the lows that they reach. So twice we've seen this. And as I say, when I was talking earlier, you've got the tighter risk trade. The tighter risk trade is to have a go at buying this low on the second dip to it, or buy just off the low. If you see this move down quickly into the low, then buying 82s, 3s, 4s with a stop below 81. So maybe your stop could be as little as 78. Give yourself 3-4 ticks on that. And that gets you in nice and early for the trade. Obviously, you've then got to sit through quite a bit of nothingness until we get the actual trade. And the actual trade is going to be buying this candle. Now, this has worked out very nicely. You've got the break of the 63.02s. You've also got a retest over here. That is ideal. If you're not in on this first move up, the first break, you've got a retest back. That's your chance to get in. If I'm getting in there, I'm looking to have my stop below this high. Certainly for a close, if you're looking on a closing candle basis, I'd be looking for a close below that high, just to give you a little bit more room rather than just any close. You know, if you see a close dropping in here, then it's not necessarily saying that the move's over. So I would be looking for a close below that high. And you have then got the continuation. Target wise, here's your most recent swing high. Obviously you're looking for a swing high because we're on a double bottom, which is eventually reached. Another thing that I do like to look for, and this is not exactly anything to do with a double bottom, but impulse candles. So this candle here, this steep red candle, tops of those candles, the first move back to the very peak of an impulse candle is often an area where you see a little bit of resistance or support. So I would have been looking at least to this area. If you're looking to scale out of a little bit of your trade, that's going to be the target for your first little bit of a scale. Otherwise, there's your main target. So even if you take the big stop and have your stop below 80s on the break of this, once again, you're getting about a 2-to-1 risk reward. You're getting 40 ticks to the upside for around about a 20-25 tick loss. So that's how I'd look to be playing those types of price patterns, your double bottom, double top. So I've talked about levels, about how you would trade certain levels, and a level can become quite arbitrary. Ultimately, the level is drawn by you. You may say that the level is at 81s. Someone sitting 2 desks down from you says the level's 77. Who's right, who's wrong? This is where levels can trip you up a little bit because of the fact that they are entirely decided by yourself. Indicators are not. If you have an indicator, if you put a 200 period moving average on a chart, then the 200 period moving average is the same for everyone looking at that chart. So what they do is an indicator gives you context. That's the most important thing. So it can inform you whether a level is strong, whether a level is worth trading. You could have a big level that you've been looking at for a long time, but come the time that it gets there, if the indicators are also not matching up, then your level is perhaps not as strong as you initially thought. So a few things to be thinking about: how the market approaches a level. This is very important. If a market grinds to a level, then what it's showing you is that there's a lot less chance of that level holding. It has just ground its way through multiple levels. Whereas if you get a fast move to a level, this is often a scarier move. It is a trade that you're not necessarily going to want to take because you sort of see it come down and you think, wow, I don't want to buy that. Look how much the market's moved. But these are often the ones where it will react. And so a level becomes stronger based on the way the market approaches it. Once again, where the markets come from as well. If your market is open 5 ticks above a level and it comes down to it, it's starting to look a little bit less strong because of the fact that the day has only just begun. There could be quite a lot more range expansion on the day, and so for that to be the low or high of the day within 5 ticks of the open is often not always the case. Again, think of this in the other side, that if the market has already had a huge move, then a decent level that it's moving to then can become quite a lot stronger because of the fact that markets generally will always keep to around about the same size moves on most days. Of course, this can extend, and we will see examples of that coming up. But in general, if the market has moved beyond what is a normal range, then levels do start to become a little bit stronger. So where do these indicators come in? They are either going to give you an idea of whether the market has done too much, too little. You're going to get clear areas that are going to be watched by multiple people. These indicators are the same for everyone that puts them on. There is some variation, and I will show you this on some of the indicators coming up. They're going to give you a chance to put a trailing stop in. This is often one of the hardest things to do, to decide where to have a trailing stop. But if you've got an indicator, particularly one that continues throughout the day, I'm thinking VWAPs, moving averages, then it gives you an idea of where you could put a trailing stop. You could have it below the indicator, and that gives you an opportunity to stay in a trade, to sit with something. And also, as I say, it gives you a gauge of strength of the move. So let's go and have a look at the first indicator. Bollinger Bands. Now, a Bollinger Band is a volatility indicator. What it does is you have a 20-period moving average, here, this blue line, and you then have bands outside it which work on a 2 standard deviations from the Bollinger Band. So that is these red lines here. So you have one above, one below. The idea, as I say, because it is a volatility indicator, is that as the bands expand, volatility is increasing. As the bands contract, volatility is decreasing. So if we look here in the oil market, you can see that volatility has increased in this area here, and that has been indicated. Really, you've had this large move up over here, and then you've seen a bit of volatility continue. We have, as I pointed out earlier, another candle just here as a shooting star for you, which does call the high and is just outside the Bollinger Band. After that, you're then seeing range contraction and this consolidation here, and the bands are becoming a lot tighter. So that's what it's giving you an indication of. How are you going to use this for a trade though? And that's going to be the key thing. Now, there's a few different ways to look at them. There's the idea that you can just buy the lower band, sell the higher band. I'm not entirely that keen on it. I use the Bollinger Bands more to give me an idea of the strength of a level, or to make a level stronger or weaker going forward. So if we are outside of the Bollinger Bands, you'll then get into a point that the market would consider overbought, oversold. So once you're outside, you're then thinking in terms of, is there a level that can come, that I can get in on, that's going to draw the market back inside? Now, they can stay outside for quite a long time, or they can sit around the lower bands or the upper bands for quite a long time. We've got a good example here on an hourly chart where we do stay outside for quite a while, and once again to the upside. So they will stay outside for quite a while, but then once you start getting back within, as you can see on both of these examples, you do then get the move in the other direction, beginning here and again beginning down here. So that's one way of looking at it. As they start coming back in, you are then looking for a move back towards the middle band, just here, and eventually you get it here. So it does take time to move back into them. My favoured trade with a Bollinger Band, however, is a move to a steep band. If the band is become very steep, in this example here, the band's moving down very steeply, a move back to it, I often find, is a very good entry on a trade. And that's how I tend to use the bands. You use it for a swift move and a swift move towards a very steep band. If you are looking at it, say, in this area, any swift move to a band for me would not be a move that I would deem worthy of a trade. However, if you get a swift move towards a steeper band, i.e. down here, after we've been quite a long way away, it didn't reach it, I do know, I can see that, then that's where you're going to be looking for a trade. Once again, you've got this area here. You can have a go at this trade. Your stop is going to be above this most recent high. So obviously your stops are a little bit more discretionary in terms of you've got to pick the stop. There's no sort of way of really clearly defining the stop. Again, if you bought the move to this steep upward sloping middle band, then your stop's going to be below this low. And the number of ticks, again, always depends on your market. And of course, once you get in at the bands, you're looking generally for a move to the next band. So again, if you're in here, you're looking for a move back to the top band. And likewise, if you do it on the extremes of bands, then you're looking for a move back the other way. So we've got a nice little example of this in the oil. First off, got this on a 15-minute chart down in this bottom corner down here. You got a flag, the flag breaks, and then we get a continuation lower. Now, what you're seeing is, as this continuation happens on this chart, you're getting this move down here. We're getting right on the edge of the Bollinger Band. We're starting to move outside the bands down towards these lows. And that's partly why the flag doesn't actually reach its target, because the market is getting a little bit too far, a little bit beyond itself, and there will be people who are actioning trades as we start moving outside of the Bollinger Bands, and that is what's going to suck the market back higher. As you can see, you're also moving outside the daily band as well. So once again, quite a few reasons why people will be entering the market and trying to buy it back. So what happens is the flag fails. It fails to reach its target. You get these couple of rejection candles, these two here. Both times long wicks on the candles, price is rejected, moves straight back up into the range. And you then see this impulsive candle higher. Reason for that is people have finally started giving up. You get new buyers come in the form of shorts getting out of their trades, but also once you've got the move back above these previous lows coming in at 52.36, you start getting more and more buyers coming back in to try and push the market back higher. So what are you then thinking? All the time you will have been looking on your hourly chart, your bigger time frame charts, and this would have come up as quite an obvious level, these 59.92. So you've twice seen the market come down, dip to it, and hold around the 52.92 area. So immediately you're thinking, right, that could be a level that I want to have a go at trading. Now, if we had stopped just here and moved back to it, it may not have been quite so strong. However, we've been quite a long way away from it. We're now moving back. As we mentioned earlier, remember, levels can become more of a zone than just a level. So you've also got these couple of lows just here, 53.02s to 05s area. So you've got around about a 10 to 15 tick range on that actual level. So what we see is the market charges back up on the 15 minute. This one move in 15 minutes takes the market a full 60, 70 ticks straight back up to the middle Bollinger Band here. That's your clue to have a go at selling it. Yes, you may wish to scale into the trade, so you could have some sales at the 92 area. So you get short there, but what you've got to be thinking is the market has got to get beyond that middle band. It's got to get beyond these 03s, 04s to actually get you out of the trade. So be aware of that as it's coming up. You'll be able to see the market slow as well on these impulse moves. That offers you the sell on the steep band, and then you're looking for the move back lower. Now, once again, remember that the market has already been outside of the band, so we've already had quite a big range. You're not necessarily looking for a new low, but what you are looking for is a bit of a pullback. So your first target is going to be this high at 68, and then you're looking for a move back into this range. And really, that's where you're going to be looking to be starting to take some of your trade off. And I would be looking, really my main target, back into this area here, where you've got quite a bit of volume done, and ultimately these 36s. Anywhere beyond that, I think you're then starting to be looking at a bit of a bonus trade, but ultimately the back to the lower bound of the Bollinger Band is going to be the bigger term trade and that. So that's how I like to use Bollinger Bands. It's more something that makes a level stronger as the market comes back to it, as opposed to just an idea of whether the market's getting a little bit too oversold, overbought. One last thing as well, just to point out, once again, flag retest works very nicely. So you've got multiple reasons to be selling the low 53s, high 52s. You've got the flag retest, you've got the levels from 52.92 to 53.03, and you've also got the Bollinger Band. So when things start adding together, this is what makes a market a lot stronger. Let's have a quick summary. Bollinger Bands. It's a volatility indicator. The moving average in the center is a 20 period, and the bands outside are 2 standard deviations away. In general, an expansion of the bands gives a range extension and a tightening of the bands. You're looking for smaller ranges, but what you've got to be thinking then is you're going to be looking for breakout opportunities. Wait for them, of course, but as you start seeing the markets start to turn, the bands will then begin to turn, and that's where you get the volatility picking back up. If the market should be starting to get outside of the bands, again, any moves back in, any opportunities to play the market back towards the range, sort of a mean reverting style trade, you're looking back to the middle band. Any fast moves to a steep band off a good trade location, and levels outside the bands increase in strength.